Ladies and gentlemen, good day and welcome to Q2FY25 earnings conference call of JK Tyres and Industries Limited, hosted by Emkay Global Financial Services. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chirag Jain from Emkay Global Financial Services. Thank you, and over to you, sir.
Thanks, Nia. Good afternoon, everyone. On behalf of Emkay Global, would like to welcome you all to the 2QFY25 earnings conference call of JK Tyres and Industries Limited. Today we have with us the senior management team represented by Mr. Anshuman Singhania, Managing Director, Mr. Arun K. Bajoria, Director and President International Business, Mr. Anuj Kathuria, President India Operations, Mr. Sanjeev Agarwal, Chief Financial Officer, and Mr. A.K. Kinra, Financial Advisor. We'll begin the call with opening comments from the management team, followed by the Q&A session. Over to you, sir.
Yeah, thank you. Very good afternoon to everyone, and welcome to JK Tyre Q2 FY25 earning concall. On behalf of the entire JK family, I would like to extend my warm wishes for a very happy and a prosperous festive season 2024. To begin, I would like to share key performance highlights of the Indian economy and the auto sector, followed by Q2 business performance. India continues to be the fastest growing economy despite geopolitical uncertainty. Few factors like strong growth in manufacturing, robust credit growth and GST collection, rural economy rebounding, and stronger exports in service and high value manufacturing has strengthened India's position further. We firmly believe that India will keep delivering superior performance which would strengthen its position in the global economy. The automobile industry is one of the key drivers of growth in the Indian economy. However, the performance was mixed bag during the quarter. While the commercial vehicle segment degrew by high single digit on account of extended monsoon and moderation in infrastructure spend post general election. Passenger vehicle segment sustained on a high base. 2-3-wheeler witnessed robust growth of more than 12% in Q2. JK Tyre being a CV major, the OE sales was impacted by the drop in CV production during the quarter. However, for the domestic market overall, the volumes were flattish over the previous quarter. As we move into the second half of the year, we expect the demand to improve, driven by festive season, resumption of government infrastructure spend, and normalization of construction, industrial and mining activities. Further, premiumization trend shall continue across sectors, including auto led by increasing aspiration, changing lifestyle, and greater availability of ease of finance. Domestic passenger car radial has significantly improved over the previous quarter in the replacement market. Now coming to the Q2 business performance, overall revenue were recorded at rupees 3,643 crores as compared to 3,905 crores in the corresponding quarter last year. Overall domestic market volume contracted in high single digit, primarily driven by the OEM segment. On export front, volume remained flat on a YoY basis, but showed sequential improvement in high single digits. Export demand continues to recover from all markets like American continent, Asia, Middle East. Introduction of new products and expansion of footprint in our own target markets. We are confident that this growth will sustain in the second half despite continuing supply chain issues and uncertainty in the geopolitical scenario. On the margin front, EBITDA margin contracted sequentially due to high raw material cost, which increased by approximately 6 to 7% compared to Q1. We have been actively working to mitigate this impact through judicious pricing actions and product mix enrichment coupled with operational efficiencies. Presently, we are witnessing a correction in RM prices. During the quarter, we further expanded our market reach in the replacement segment by adding 23 brand shops, 40 plus fleet customers, 2 large accounts in the mobility business. The ongoing capacity expansion programs in TBR, PCR and all steel light truck radial tires for an aggregate cost of 1400 crores is progressing well. In our continued efforts to strengthen our brand visibility, JK Tyre has been recognized as an icon brand of India 2024 by the Economic Times for the 5th time. At JK Tyre, we have embraced digitalization as a strategic catalyst to enhance operational efficiencies across functions, including manufacturing, marketing and sales. By integrating digital and predictive technologies with AI, we are accelerating the innovation and product development. It is indeed a matter of pride that JK Tyre has been honored with the prestigious Mahatma Award 2024 for the CSR excellence. JK Tyre is a green company and it is committed to reducing carbon intensity by 50% by 2030. Sustainability is at the core of its activity, be it manufacturing excellence or development of the next generation technological advanced product. Now I would request Bajoria ji to talk about the performance of JK Tornel, Mexico.
Thank you, MD sir. I will now share the highlights of Mexican economy and JK Tornel, Mexico for the second quarter of financial year 25. Mexico's economic activity slowed in the second quarter of 2024 following the establishment of the new government. GDP growth decelerated to an annualized rate of 0.8%, down from 1.1% in the previous quarter, and employment growth rates also slowed down. Peso weakened against the dollar, which should support exports in the coming quarters. The IMF projects Mexico's GDP growth forecast for 2025 at 1.5%. The positive development for the Mexican tire industry is that the Mexican government imposed anti-dumping duties at 32% on imported passenger cars and light truck tires from China, effective 1st October 2024. This move is expected to provide a significant boost to JK Tornel's domestic sales of PCR tires. Now, coming to quarterly financial performance, JK Tornel Mexico registered quarterly sales of 1,342 million pesos, which is equivalent to rupees 593 crores, lower by about 8% on year-on-year basis on constant currency terms. EBITDA margins sustained at 8%, that is 106 million pesos, equivalent to rupees 47 crores. However, due to depreciation of Mexican pesos, which is about minus 10% vis-a-vis the Indian rupees. The overall revenue and profitability were further impacted in Indian currency. During the quarter, raw material cost has increased significantly by 11% over previous quarter. To offset this impact, we have taken strategic price increase across categories and could increase our net sales realization by about 9%. In an effort to boost sales of passenger radial tires, 18 new SKUs in the premium category have been introduced to the market, with plans underway to launch over 14 more premium SKUs by December 2024. These efforts have resulted in increasing PCR capacity utilization to nearly 90%. J.K. Tornel is onboarding new customers in the mobility and mass merchandise segments. Recently, it has started supplying premium SKUs to Walmart, Mexico. Now, I request Mr. Sanjeev Agarwal, our CFO, to brief about the financial performance of the quarter.
Thank you very much, sir. So let me briefly share the key highlights on financial front with you all for Q2FY25. The first one is the consolidated revenue for Q2FY25 were recorded at rupees 3,643 crore as compared to rupees 3,905 crore in the corresponding quarter last year. EBITDA margins during the quarter were recorded at 12.2% vis-a-vis 14.1% in the previous quarter, contracted by 195 basis points due to higher raw material costs, primarily driven by significant rise in natural rubber prices, while the crude oil prices remained moderated at present. Profitability at EBITDA level was recorded at rupees 443 crore as against rupees 597 crore in Q2 last year. On quarterly basis, cash profit stood at rupees 323 crore as compared to 488 crore in Q2 FY24. Profit after tax stood at rupees 144 crore. Consolidated capacity utilization for the quarter was 83%. The utilization of radial tire capacities remained strong, ranging between 85 to 90% for various segments at present. Consolidated exports stood at rupees 693 crore, up by 6% on YOY basis. Subsidiary companies Cavendish Industries Limited and J.K. Tornel Mexico continued to perform well and have contributed significantly to the revenues and profitability on consolidated basis. Cavendish posted a top line of rupees 957 crore with EBITDA at rupees 123 crore, registering an operating profit margin of 12.9%. Earnings per share on consolidated basis stood at rupees 4.93 per share in second quarter. Return ratios in terms of ROC and ROEs are within the mid to high teens range and are expected to improve going forward. Net debt stood at rupees 4,340 crore rupees as on 30th of September 24 as against 3,704 crore in March 24. The debt levels have risen due to increased working capital borrowings, primarily related to a strategic build-up of key raw material inventory. For FY23-24, the company paid the total dividend of rupees 4.50 per share, including an interim dividend of rupees 1 per share paid earlier, and the final dividend of rupees 3.50 per share was paid during the quarter. On September 16, the Board of Directors of JK Tyre and CIL respectively approved the scheme of amalgamation which involves the merger of Cavendish Industries Limited into the parent company JK Tyre. The merger aims at synergizing the benefits, simplified structures, unlocking value for the shareholders, and consolidate tire operations into one single entity. As per the swap ratio worked out, the shareholders of CIL will receive 92 shares of JK Tyre for every 100 shares they hold in CIL, in Cavendish Industries Limited. The proposed merger will go through several approval processes and is expected to be completed within the next 10 to 12 months' time. And the leverage ratios, the net debt to equity and net debt to EBITDA, remained within the comfortable zone of 0.9x and 2.15x as on 30th September respectively. The balance sheet and the return ratios of the company have been within the healthy levels. Now we open the session for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amarkant Gaur from Axis Capital. Please go ahead.
Yeah, thanks for taking my question. Sir, I had two questions. One was regarding the growth that we have seen in the OEM segment quarter over quarter. What is contributing to that? Because most of the OEMs, we haven't seen a great growth in the production sequentially, and a commensurate decline we are seeing in the replacement segment when sequentially we typically see an improvement in the second quarter. So could you shed some light on those numbers, please?
Yeah, in the OEM, in terms of the segment, here CV market has definitely the truck, especially the MHCV, has shown a decline, and that has been quite sluggish in H1. Then in the passenger car, there has been growth in H1. There has also been a growth, high double digit in the 2-3 wheeler as well in the segment. So that is for the OEM.
Sir, I'm talking about sequentially. From the numbers that I have, there's about 100 crores of addition, almost 15-16% addition in the revenues quarter over quarter. When the growth in two-wheelers might not be that great, maybe around low single digit, 6 to 8% kind of growth there, and CVs would be largely flat and CVs would be lower. So would that mean that we have gotten into more OEM, certain models where we are present have done relatively better?
No, so in terms of the numbers, for us, there has been degrowth in the OEM when it comes to truck. We are the largest. We have got impacted because we are the largest participant in the OEM in the CV segment. One, there has been a flattish. There has been a flattish for LCV and SCV in terms of the OEM this thing, and in the passenger car we are it has been a minor growth. for us in terms of volumes. And we have been flattish in the 2-3 wheelers. This is on from the sequential quarter.
Okay. And regarding replacement, sir?
I'm sorry?
Replacement segment?
Yeah, replacement, we are from the corresponding quarter, we have grown in terms of 3% in volumes. And even on the sequential, overall volumes have grown. Okay, thanks for that. My second question relates to the pricing actions that we are seeing in the market and the competitive intensity that has been relatively high in certain segments and not in others. So could you please elaborate the kind of competitive intensity you are seeing in the market as far as pricing is concerned, and which segments are the most competitive, and how much price hikes have you taken in individual segments over the last couple of quarters? So you see, we have been able to take about 3 to 3.5% in H1, and in various categories there are obviously various different level of price increase. We've also got price increase by the OEM as well, apart from the aftermarket. Okay, and regarding the competitive intensity, if you can comment. It is the market is dynamic. Each company is on their own to decide about the pricing strategy. So we are in a very competitive environment. Why I'm asking that is because in the past a lot of your competitors have been quite vocal in terms of being very prudent on price increases and protecting the margins. But lately margins have come under pressure quite a lot, and we have seen some of the competitors also resorting to some pricing action to protect market share rather than the margins. So is that something that you are seeing in the market as well, or that is something you believe that is maybe a shorter term phenomena, and we might see more price competitiveness coming through going forward?
Actually, it's not only about the competition, but it is also about the ability of the market to absorb the increase. So we are working on that. As you are also aware that the freight rates have not been going up to that extent. So therefore, we found that the market, especially in the replacement market, the opportunity to pass on was not there. We have taken increases. I'm especially talking about the commercial vehicle segment. But if you take the passenger car, we have had a much better increases that we have been able to take. So with the the overall demand, the availability of freight that will get better in Q3 and Q4, we feel that the opportunity to take further price increases should be better.
Understood. Thank you very much, and all the best.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Abhishek Jain from AlfAccurate Advisors Private Limited. Please go ahead.
Thanks for opportunity. Sir, in house CV segment, how is your revenue mix in TV versus TBR? And how is your market share over there? And what is the outlook for the replacement demand in TBR and TBV?
TBR and TBV. Replacement. So as I was saying that the
On TBR, the replacement demand is holding on, I would say. And it is, when the new vehicle sales are a little lower, the replacement market generally picks up. So we have seen that the quarter two was a little muted as compared to quarter one because of the monsoon, and even the monsoons got extended, in which the construction and mining activity is slowing down. But otherwise, we see that the demand in the long haul segment is holding. Even in PPR segment, we have found that the demand is in the replacement market is pretty steady.
And how is your revenue mix over there, TBR versus TBB?
TBR actually has grown at a little higher rate as TBB, but I would say TBB also there has been a growth. It has not come down. So overall, the total, say in the replacement market, the total size of the market has increased, but in that the increase is more for the TBR.
So in commercial vehicle, revenue contribution is around 53 to 55%. There, how much revenue mix for TBB versus TBR?
Say, in terms of revenue, the total truck bus accounts for almost, say, 50 to 53% for us. And there, roughly 40% comes from TBR.
40% comes from TBR. And as you are adding the new capacity, most probably that this ratio will increase?
Yes, absolutely. The TBR
ratio will further go up, because now we are seeing that even in the mining segment, the use of TBR is increasing.
And our capacities are all being set up in TBR, not in TBB.
Okay. So because of the capacity constraint, your TBR percentage in overall revenue is lower, right?
Within the segment of truck and bus, the TBR definitely will go up, but overall, in terms of revenue contribution, I think because we are setting up large capacities for passenger line radius, so that will go up.
Yeah.
Okay. And my next question is on Cavendish. How do you see volume growth over there in next 2 years, sir?
The overall, if we see, first of all, the overall in terms of Cavendish or JK Tyre, we consider like one unit only. But just for the sake of your question clarity, the increase percentage is yeah. So the growth percentage you're talking about, right? The growth in terms of this JK Tyre will be higher going forward, because of the increase in passenger line radial tires capacity is getting added.
So I'm asking about the Cavendish now. They have achieved a revenue of 975 crores. So how do you see the revenue growth over there, and what would be the key drivers of the revenue growth and the EBITDA margin over there?
So the EBITDA margins are definitely better presently in the case of Cavendish Industries Limited. And going forward, in terms of EBITDA margins, I do not know, but the passenger vehicle margins are better. So I believe that this will move in tandem with Cavendish Industries in the case of JK Tyre also.
Yeah, but Cavendish, the revenue
growth,
there, because we, as you know, we are announced a capex of around 260 crores.
61 crores.
So that will add to the tonnage that we'll be able to produce over there. So therefore, we expect that this additional capacity will get utilized in FY26, and therefore it will result in a revenue growth.
Okay. And my last question on the Tornel Mexico. So how much export in overall revenue in the Tornel Mexico, and what are the key markets where you are exporting?
Can you repeat your question, please?
My next question is the Tornel Mexico. So how much export of the Tornel Mexico in the different countries, and which are the key markets?
The key markets for export from Mexico are Brazil and Latin America. And in Latin America, it is Colombia, it is Argentina, Venezuela, Cuba. So these are the countries, and they keep varying because it depends on the exchange rate of those countries. As you know, that the exchange volatility, whether it is Brazil, the real was at around 4.7, 4.8 reals to a dollar. Today it is about 5.6 reals to a dollar. So the import into Brazil has become, to that extent, much more unremunerative, very expensive. And so also the other countries in Latin America. For example, Argentina and Venezuela, the exchange rates are absolutely gone haywire. But however, the total exports versus the domestic is something like 41% to 59%. Let's say 60% is domestic and about 39 to 40% is export.
Okay, so because of this imposing duty on the Chinese companies by the 32% rate, domestic business will see a significant growth from this quarter onwards?
Yes. We are expecting our domestic sales to go up significantly going forward. That is from November 24 onwards.
Thank you, sir. That's all from my side.
Thank you. The next question is from the line of Mithun Shah from DAM Capital. Please go ahead.
Sir, thank you for the opportunity. Sir, my question again on the Mexico Tornel. Sequentially, Q2 is always strong on a Q-on-Q basis, and we have seen 10, 15, 20% type of a revenue growth compared to Q1. This time it is a decline. So as initially you highlighted about this new government formation related challenge, etc. But anything one time, or it is overall slowdown which has impact on the Q2 and we'll see similar impact at least for next few quarters?
No, basically the subdued demand sentiments in the Latin American markets have been impacting our exports. So that has also impacted the overall sales, as you have seen. And the currency depreciation, that is the Mexican peso versus the rupee, as I said, that it has come to minus 10%, is leading to lower conversion rate. So in terms of peso, it is not so less, but when you see in the consolidation which takes place when we get the figures from Mexico into India as per the Indian GAAP, then this difference is seen, because earlier when we were converting peso sales into Indian rupees, it was at 4.5, 4.6, and today it is at 4.2. So that is the difference that you are observing. As I said, that is 10 to 11%.
On a sequential basis, sir, Q-on-Q 10 to 11% you are talking?
Yes.
Okay. So, and second question is on how much would be roughly inter-segment between Cavendish and JKI?
This is approximately 250 crore rupees. The inter-unit sale you're talking about, right?
Yes, sir.
250 crore in the quarter.
And lastly, sir, any meaningful benefit of this restructuring of Cavendish going forward, it merging with the JK? And
so many benefits, of course, would be accruing to because of this restructuring or the amalgamation which has been proposed and approved by the board of these two companies. And some of them will be large economies of scale which we can get the benefit of. And also the simplified structure, the cost benefits, the ease of doing business, and also some tax benefits which will accrue, because there is some carried forward losses in Cavendish in income tax. not in balance sheet. So in income tax, whatever carried forward losses are there, so those will get, let's say, set off over the year, or maybe in 1.5 year or 2 years time, and that will be the benefit to the
and unlocking value of the stakeholder and consolidated tire operation into one single entity.
Right. So
Right.
we see a lot of synergical benefits. So we thought that this would be the best time, and the ideal situation is because now Cavendish Industries also is generating a good amount of profitability and business. So this has stabilized now more or less. So it is the best time to give the benefits of, to reap the benefits of the merger.
Some publicity will be reduced, which will retain two companies. So that will give us some benefit of to the cost.
Right, sir. Right. Great, sir. So can you quantify these losses? How much would be those carry forward losses which can be used as a benefit for next year?
Exactly, it would be very difficult, but we will work out and we can discuss separately.
Okay, sir. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Aditya Akhani from Omkara Capital. Please go ahead.
Thanks for the opportunity. Sir, could you help us with the revenue product line for either for India business?
Sorry, your voice was breaking, so can you repeat your question?
Yeah. Could you help us with revenue mix by market and product line for India business for either Q1, Q2 or H2? H1, sorry.
So by market, the broad numbers I can share with you. The replacement is the 60% kind of the revenue. OEM is about, again, it's varying from time to time depending upon the situation. But this is between 26 to 30%, and the exports remaining.
This is for Q2 or H1?
This is for Q2 I have talked about.
Okay.
Both are more or less similar. Hello?
And revenue mix by product line?
And revenue mix by product line, truck and bus is again the major contributor to the revenue to the extent of about 60%, and passenger car radials would be about 30% and balance, not 30% exactly, but it is also improving. So let's say about 25-26%, and the balance is from two-wheeler and non-truck.
Okay. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Amit Agarwal from Leeway Investments. Please go ahead.
Good afternoon. Just wanted to know 6 months volume. What is the growth in the 6 months for last quarter? Sorry, YOY.
Could you please repeat the question?
What is the volume growth YOY 6 months for the 6 months?
YOY
For first
For Indian operations.
volume growth.
One second, please. On H1 FY24 compared to H1 FY25, the domestic sales volume was around lower single digit.
So could you define the exact percentage?
See, this was not across the categories. Actually, this lower number in terms of volume basically was because of the 2-3-wheeler segment, where the value is not substantial. And
no, that's okay, but I just wanted to know the exact like price rise and the volume growth so that I can, it helps me in forecasting the future growth of the company. and the capacity utilization of the company?
Correlate that, then it is better to look at the tonnage rather than the.
In any case, as we have discussed in our Anshumanji talked about in his speech, this quarter is not the real representative quarter for the future growth of the company, simply because the OEM was not doing so well, and therefore this is a picture completely different this quarter. So
that I understand, but still it's better if you could give me the percentage. Is it 2%, 5%, 6%, or 3%? Or is it negative? Because the turnover has been stagnant. So I just wanted to get an idea what is the price rise and what is the volume growth in Indian operations.
So in terms of market segments, we can talk about this. So replacement is low single digit, OEM is double digit, low double digit, and then export is positive high single digit.
Okay, and so what is the capacity utilization of the Indian operation?
85 to
90%. Again, segment-wise, it is completely different.
Radial capacity is 90%, and the other overall is 85%.
Yes.
So, what is the increase of expected in the capacity in next 2 years?
Next 2 years?
Yeah.
So it will all depend upon the kind of demand sentiments, and we are very hopeful that the demand will improve not only from the third quarter, but overall the demand sentiments will remain very positive because of the good GDP growth which is expected going forward. So we are.
So that's okay, but I think in last con call you said we have been investing 900 crores around about next 2 years. So there will be some expansion on the capacity. So just wanted to know how much will be the expansion of the capacity.
Okay, I will tell you that also. So for the time being, because you asked me about the capacity utilization in next 2 years, I think it would be for radial again plus 95%, and for the bias in the similar range of about 80%. Okay, and as far as the new capacities which are under commissioning, so we see that because we are expanding our capacities mostly in passenger car radial tires, so these capacities will be fully utilized. And these are all large capacity which is getting added in PCR and also in TBR and also in one of the other segment which is all steel trucks, light truck radial tires. So these are the 3 categories where we are adding.
So should we expect around about 20% increase in the capacity, total capacity, including bus, including passenger cars and scooters?
No, car is definitely getting added, but in scooters we have not announced any increase in capacity.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Mayur Milak from AMSEC. Please go ahead.
Yeah, hi. So on the RM basket, sequentially you said it is up by about 11%. Have I read it right?
No, sequentially in the RM basket it is an increase of 6 to 7%.
6 to 7%. Okay.
Corresponding it is 13% increase.
Yeah.
Okay, 13% was YOY you said, and 6 to 7% QOQ.
Yes.
And in your previous call you mentioned that in 1Q your price realization increased by about 2%, and you had taken a 1 to 1.5% price hike in the month of July. Now overall you mentioned that your price hike for the first half has been 3.5%. So largely post July we have not really been able to take any price hike because of the softness in replacement demand. Am I reading that right?
No, your numbers are correct. So by H1 we've been able to take cumulatively about 3.5% price increase, and we are assessing the situation now in this quarter as well. In third quarter as well, we are assessing the situation to see the market dynamics, and through that we will be taking our decisions of price increase.
Sure. But so far, till November of this quarter, you haven't really taken any price hike.
No, we have announced a price hike in the TBR segment in the end of October.
Okay. Okay. So you've taken one already in this quarter as well.
Yeah, only for the TBR.
For TBR, right. And sir, coming to overall the demand scenario, so I think clearly the industry is reading a typical low single-digit demand scenario, which largely means a steady replacement demand and maybe low single-digit OE demand. Now, from what I understand, almost 70-75% really comes from replacement. So any particular reason that you see that why the replacement has kind of been very sluggish? OE, we understand, there's an inventory thing, but why is the replacement not really picked up?
So the replacement demand, actually, what was expected in the beginning of the year, it has not played out to that level. And
yes.
Quarter 2 was in particular more muted. Maybe this time we had extended monsoon and the construction and mining activity also had slowed down during this period. But now, and even because of the elections, the capex that is generally invested in the infra did not happen. So all this, the overall economic activity was slow. The movement of the core sectors such as cement, steel, even, that was also curtailed to a large extent because of the construction activity being muted. So now with all that we see that the government spend will be much better in infra. We will see movement in the core industries. We will also have now with the rural economy also starting to churn, I think so overall the economic activity will increase. And that would also result in better utilization of the vehicles with more freight availability.
Sure. Sir, one structural question, if you allow me. So the direct freight corridor is pretty much on its verge of getting completed, the western corridor. What we understand from the experts on railway is largely that there could be a dramatic shift of goods from road to rail, which will have its own sweet impact on the MNHCV industry per se. So if the overall run were to come off, does it also mean that the replacement cycle in the MNHCV should kind of see a structural slowdown in the next 2-3 years? Any take from your side? Have you done any kind of reading into that?
See, over here on dedicated freight corridors, it is not yet in place. But what we have understood, and we in dialogue with our OEM customers, because they are also monitoring this very carefully, finally the total freight availability or the freight movement will be increasing somewhere similar to the GDP growth rate. That is quite closely correlated. So what the OEMs are also working upon is to make the overall per ton per kilometer transportation cost by road more attractive than the rail. So that is one thing which they are working on by improving the vehicle dynamics, vehicle performance, and we are also working along with them to improve the fuel efficiency or even the other cost per kilometer of the tire also. So that, in my view, should, despite the dedicated freight corridors coming in, which will take some part of the freight, and especially there where there is, point-to-point movement is possible, say maybe cement, maybe steel, but wherever transshipment is not something which is going to help, there either it will be road or at best it will be multimodal. So finally, in the long term, 5 to 6 years, there will be a lot of multimodal. But in our understanding, even in a developed economy, say if you take China, even there, till date, the road transportation is almost accounts for 60 to 65% of the total movement. And the road infrastructure is also improving. with the national highways and also the state highways being built. So we feel that while, some of the freight will move towards the dedicated freight corridors, but it will not reduce the overall, the availability for the road sector.
Okay. So your view is the industry will continue its capex as anticipated.
Yeah.
Absolutely.
All right. Thank you so much.
Thank you. The next question is from the line of Basudev Banerjee from CLSA. Please go ahead.
Yeah, thanks, sir. Just to continue with cumulative price hike and 6-7% sequential raw mat basket inflation. But if I look at so just to continue with the price hike aspect which you just now discussed, and the raw mat basket sequential cost increase. But if I look at last 1 to 2 months, natural prices are almost by 25 from the high, and crude oil prices are below 70.
Sorry to interrupt you, sir. There is a disturbance in your line.
Am I not audible?
Yes, better.
It's your
I'm saying, sir, the raw mat basket which moved up 6-7% in Q2. How do you see that with today's commodity price come down in Q4 per se, not in Q3, because it will have a lag effect. So this is with respect to the question of further price hike, whether price hike is required at all or not, because commodities would have corrected equivalently by Q4 at today's price.
In Q3, definitely, the price hikes would be required, but it will finally, find its own level as to the raw material prices will also start softening. So while there will be some lag effect which will go into Q3, but maybe more towards the end of the quarter, we may see some softening happening. And definitely there will be, we are looking out for further increases, but that will purely depend on the market's ability to absorb that increase. As I mentioned earlier, one increase we have taken at the end of quarter, the end of October, and we would be looking at other segments if there is any opportunity.
Sure. And second question, sir, last time when one can recall that you have reduced prices in replacement market to pass on commodity benefit?
Could you repeat that question, please?
The last time when did JK or industry in general reduce replacement market prices to pass on commodity price benefit?
No, that was not a significant thing. It was mostly because, if you remember, prior to that there was an increase, sharp increase of 40% plus in the commodities. So overall, if you see, we were able to sustain whatever increases we had taken, even when the commodity prices had softened thereafter.
Sure. Understood. Thanks.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next follow-up question is from the line of Abhishek Jain from AlfAccurate Advisors Private Limited. Please go ahead.
Thanks for opportunity again. Sir, as you mentioned that you are adding the capacity in the TBR and PCR, and these are the fully utilized now. So what would be the incremental revenue in FY26 because of these capacity addition?
So whatever capacities we are adding, these are all brownfield projects, and we are expecting 1.1 to 1.2 times the investments. That is the kind of increase in revenue we can expect.
So when these capacity will be commissioned?
So these are getting commissioned in different quarters, but you can broadly assume that the second half of FY26, all the capacities will start, and then we will have to ramp it up over the next 2 to 3 quarters roughly.
Okay. And sir, as you import raw materials to different countries like Indonesia, Vietnam, and so just wanted to understand what is your import requirement, what is your RM requirement comes from the import, and what is the difference in the prices now, domestic versus imported in terms of the RM?
See, again over here, if you take the different components in the RM, the import percentage or the dependence is one of the largest areas is in the natural rubber, where again it varies from quarter to quarter because the production of the domestic rubber is also not uniform throughout the year. So there, that is one area, but there are other areas where I think so now the domestic capacities are being set up. For example, say carbon black, but there again for reasons, in some cases reasons of capacity, in some cases other commercial reasons, we keep on importing, but very difficult to give you figures because it is strategic and tactical, which changes from every one quarter to the other quarter. So we play it out that way.
So import must be more than 50% of the overall requirement. Hello?
Sorry, could you repeat your question?
Sir, I was saying that import would be must be around 50% of the total requirement of RM.
No, not really. But again, it varies from quarter to quarter.
It's very quarter to quarter. Okay, and as that freight rate was very high in last 2 quarters, but now it has started to go down. So because of this, will you gain the benefit in other expenditures?
You're talking about the
Yeah, international freight rate.
So ocean freights had gone up, but now they have started coming down again. So when the rates had gone up for our outbound, it was always being shared between the customer and us. And now also the similar situation will be there. So the impact is now mostly kind of negated.
And my last question on your overall date, what is the current date in the company, and how's your repayment plan for the next 2 years?
Debt.
So the debt repayment schedule is being followed as per what we have to pay fully, and in next 2 years, basically we will be reducing our debt by almost about 1,500 crore rupees.
1,500 crore. And what is the current net debt, sir?
Net debt to equity today is 0.8:1.
And in number terms, sir?
In terms of numbers, the net debt is about 4,000, I mentioned, 4,340 crore. 4,340 crore.
4,340. And that will reduce to the 1,500 crores, or it will be reduced by 1,500 crores?
It will be reduced by 1,500 crore.
Okay. Thank you, sir. Thank you, sir. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. As there are no further questions from the participant, I now hand the conference over to the management for closing comments.
Oh, it was really a very nice session we had with you all, investors and analysts. So I thank you very much, all of you, to join Q2FY25 earnings call. And I hope that we have provided all the clarifications which were asked for. Thank you very much. Have a good day. Thank you.
Thank you.
Thank you.
Thank you very much.
Thank you. On behalf of MK Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.